Hi everyone, welcome to Short and Sweet Accounting, where we break down accounting topics into bite-sized videos. I'm Brendira, your guide to mastering accounting topics in under 10 minutes. Today, we dive into how to prepare a journal entry. Why? Because a journal entry is the key ingredient in accounting and preparing financial information. Let's get started. So, what are journal entries? Journal entries are records of a business's transactions in accounting. This concept is crucial because whenever a business does something of economic importance in accounting, a journal entry has to be prepared to show how this action affects the finances of the business. Why does it even matter? Understanding journal entries is important for record keeping and financial statements. For example, yes, the software can record your expenses and revenue, but how will you ever adjust an account that seems incorrect without a journal entry? This all affects the accuracy of your financial reports. Journal entries are extremely important. So let's break it down. Here are the key points on preparing journal entries. There are certain things or components of a journal entry that you need to understand. Every journal entry needs to have a date, at least two accounts, and at least one debit and credit. The debit accounts are usually written first, and credit accounts usually come next with an indent. So this indent suggests that this is the account that's going to be credited. The journal entry has the date. It must include the date that the transaction happened. We have to select two accounts, at least two accounts, maybe three, four, or five, but there can never be only one account selected. And in no instance are both accounts going to be the same thing. We have to identify at least two distinctively different accounts, and we have to decide whether the account needs to be debited or credited. Next, we're going to talk about how we first need to identify the accounts. The account is a place where we store all of the amounts related to a particular business transaction based on its type. When we say based on its type, we're talking about the type of account that it is. We have different classifications of accounts, which can be an asset, a liability, an owner's equity account, revenue, expense, or withdrawal. We have to first identify accounts that fall under those classifications that are based on what actually happened in that business transaction. For example, when a company pays its staff, we have to consider two accounts. One being the payroll expense account, or sometimes we call it salaries, and two, the cash account, because now the company is spending money. Based on the transaction of paying its staff, these are the two accounts that we're going to select. Next, how do we know what account should be debited and what account should be credited? In each account, every type of account, we can either choose to debit the account or credit the account. That means we have to decide if we're going to increase or decrease the account. How do we know if a debit increases or decreases an account? Well, that's based on understanding the type of account that it is. Is it an asset, liability, or revenue account? And based on the type of account that it is, does a debit increase or decrease that account? This part, I like to say, is a matter of memory. Let's take a look at the basic account types and what increases and decreases it. Asset accounts are normally increased with a debit and decreased with a credit. The same thing happens with expenses and owner's drawings. They're all increased with a debit and decreased with a credit. For liabilities, revenue, and owner's capital accounts, they go the exact opposite. They are increased with credits and decreased with a debit. They also have a normal balance side that falls in line with whatever increases the account. Now that we've selected our accounts, we need to take a look at our example. For each transaction, you need to ask yourself, how does the transaction affect the accounts that I've already identified? How does paying our staff salary affect the accounts of payroll expense and cash? And would that mean it needs to increase or decrease? Those are the things we have to think about. When we pay our employees, we are giving the cash over to the employee. In other words, the business now has less cash on hand because it's giving it away to its employees. As an asset account, less is written on the credit side. So cash is an asset account, and cash will decrease on the company side because it's now giving it away. That means our cash account is an account that needs to be credited. On the other hand, when we owe our employees, it's a form of an expense. And so it means that the company is now spending money in order to make money. So the expense account should actually go up to show that there's an increased cost or an increased expense, which is the salaries expense. Expense accounts, like we would have seen previously, go in line with our asset accounts, being that they increase with a debit. And so therefore, because I'm showing more expenses, that means the expense account needs to be debited so I can show the increase in my financial records. With that being said, that means that my entry for that transaction should be a debit to the expense account, salaries expense of the amount of the payment, and a credit to the cash account for the same amount of the payment. In this case, there are only two accounts that are affected. Therefore, I have one that needs to be debited, one that needs to be credited. We identify which does which, and then we have a pretty good base for our journal entry. The date, of course, would be based on the date that we actually made that payment. Let's look at an example. Another example, that is. On July 5th, a business sells a case of books to a customer for $500 in exchange for cash. When a business sells, it is recording revenue or income. We can call the account book revenue. And because it is a revenue account that needs to be increased because we're having more sales, then that means, if you recall, revenue accounts increase with the credit. So therefore, we have to increase the account by crediting it in the amount of $500. Because the exchange of the books was for cash, this means that the business now has $500 more to add to its bank account. The account bank can be used, and due to the increase in cash, we have to debit it. Bank and cash are both asset accounts that increase with a debit. So therefore, we have to increase the account with a debit for the $500. The entry then would look like this. July 5th, when the actual transaction happened, we're going to debit book revenue for $500 on the left side and credit bank $500 on the credit side or the right side. As you can see, I added the indent. This would be the correct way to write a journal entry in this case. Let's talk about common mistakes when preparing entries. Common mistakes that I've seen are not selecting the right account. Make sure you identify the correct account. Then, debiting and crediting sides that don't equal. There's no instance when our debit side should be $100 and the credit side only $50. When we add up all of the debits and all of the credits, they should always agree. Debiting an account when it should be credited. We have to identify how the account is affected. Should it increase? Should it decrease? And go based on the rules for the type of account and whether our debit or credit increases and decreases the account. That gives you a pretty good idea. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more quick accounting tips. Leave a comment or two and let us know just which other topics you think we need to cover. For additional resources, practice questions, and answers so you can study at home, visit our website at the link above. Thanks for watching, and see you in the next video.